Here's your host, consultant, and financial planner, Adam Koch.
Hey everybody, welcome to the Elevate Your Business podcast. Appreciate you tuning in this week as we introduce three featured speakers in Joseph Sophia, Troy Starr, and Greg Daugherty. Let's start with Greg. He is a partner at Porter, Wright, Morris, and Arthur LLP and focuses his practice on executive compensation and employee benefits matters for publicly traded and privately held companies, as well as nonprofit organizations. He has extensive experience assisting business owners with their succession planning needs, specifically, and this is important, through the implementation of employee stock ownership plans, or as we like to say for short, ESOPs, which is what this whole podcast is about. Troy Starr is a director at Lazier Capital, specializing in M&A and specifically ESOPs. He brings a wealth of experience to his role, having previously served as the director of accounting at a publicly traded retail company, where he led multiple teams responsible for comprehensive operational accounting. He also spent several years at Ernst & Young in their audit practice, where he worked with a diverse array of clients, including Fortune 500 retail companies, manufacturers, mining firms, and other middle market businesses. And then we have Joseph Sophia. He's the regional president for First Financial Bank in Central Ohio, which includes the oversight of both commercial banking and middle market banking locally. With extensive experience in finance and stabilized commercial real estate, his expertise spans loan origination, portfolio management, and credit analysis, all while helping companies with funding for change of ownership, including but not limited to management buyout, ESOPs, passive investors, SBA, private equity, and strategic. So during today's event, we had earlier a webinar. Be sure to check that out online on YouTube. It was more of a presentation, whereas this is going to be more of a discussion. But Joseph, Greg, Troy, and I, today we're going to get into the intricacies of employee stock option plans, teach people kind of what the reality of these plans are, how they work, what the benefits are for employees, for owners, some of the tax treatments and things like that. So whether you're a seasoned business owner, an investor, or just learning about ESOPs, there's going to be something for everybody in this comprehensive discussion today. So please enjoy my conversation with Joseph, Greg, and Troy. All right, what's going on, everybody? Thank you so much for joining us today. The Elevate Your Business podcast is an educational show aimed at providing business owners with honest, authentic, fiduciary-driven education to grow their companies for eventual sale and exit. This podcast is produced bi-weekly, offering straightforward advice and expert knowledge to help you navigate the complexities of business growth and transition. So be sure to subscribe on YouTube, Apple Podcasts, and Spotify. And you can also find us on X, as they call it these days, as well as Instagram and Facebook, as well as LinkedIn. And the handle is at Elevate and Exit. If you'd like to get access to more videos, articles, podcasts, screencasts, and other educational resources, just head over to our website, which is elevateandexit.com. So enough of the housekeeping. Today, we just finished up a webinar, and you can check that out on our YouTube page if you want to see the replay. But I want to introduce our featured speakers today. We've got Joseph Sophia, Troy Starr, and Greg Daugherty. You already heard the intro and the bookend to start the show, so I'm not going to get into any more detail. But these three people together are true experts with a huge wealth of knowledge in exit planning, but specifically today through the use of employee stock ownership programs, or ESOPs for short, as a succession planning tool. Like I mentioned, Joe, Greg, and I just finished a webinar, and for those of you who missed it, we will be reposting a replay on the Elevate website, as well as the YouTube page and all across social media, so be on the lookout for that. But as for this podcast, Joe, Greg, Troy, thank you so much for hanging out and spending the afternoon with me.
Thanks for having me.
Yeah, so we're just going to hit this kind of in random order, more like a discussion than anything, because there's four of us here. But whoever wants to answer any of these questions first, fire away. But the first is just, let's get started with the simple stuff. So I think a lot of people know generally on the surface what an ESOP is. And there's lots of rumors of what it does, how it's good, pros, cons. But what exactly is an ESOP truly? And how is it different from other exit plans and employee benefit plans?
Yeah. So as a starting point, an ESOP is an ERISA profit sharing plan. It's no different, in a lot of ways, no different than, say, like a 401k plan with a profit sharing contribution. There's no employee deferral piece to it, but the profit sharing contribution is made in the form of employer stock. And just like how your profit sharing plan has a vesting schedule and allocation formula, so does the ESOP. But if that were the full story, we wouldn't be having this conversation. It does so much more from a corporate finance and succession plan. So I'll maybe turn it over to you, Troy, and say, from your standpoint, and probably what our audience cares more about than my world, what does an ESOP mean to you?
Yeah, no, absolutely. I think Greg said it well. When we start the discussion with employees of what an ESOP is, I think the easiest way to explain it is you're getting a free benefit. You're getting a tax advantaged retirement plan. If your employer came to you and said, "Hey, you're getting life insurance, so we're going to make a 401k contribution and everything else stays the same," you'd be really excited about it. And so from an employee perspective, that's usually how we start the conversation. From an employer perspective, though, it varies a little bit, right? They are selling the company. And so we really like to look at it as two different things. One, an owner selling the company to a trust where the cash flow of the company pays them out over time. And two, the setup of a qualified retirement plan. In addition to all of that, when you put those two things together, there's some really, really cool tax benefits you get to the flow through tax, the flow through profit of the company in a 100% owned S Corp pays no tax. Why do you pay no tax? Because the profit ends up in the equivalent of a 401k plan, which is a qualified retirement plan that pays no income tax. Um, on the selling shareholders side, they can also sell a company if they sell the company as a C Corp, 100% tax free. And I know we're going to get into that a little bit more as well. But at the end of the day, that's really the two sides of an ESOP.
What would you say? How can it be used, and aside from the obvious, I guess, in terms of succession? So let's talk about succession specifically.
My favorite part of it from a succession specific standpoint is typically you've got owners that kind of know the timing's right. They're talking to their spouse and they're starting to want to spend more time with the grandkids or more time away from the business, but they're not necessarily ready to hang it up, right? And you find so many of these owners that want to start to pull back a little bit, but don't want to be done with the business. They're too worried about where their employees are going to end up. They're too worried about the company continuing to succeed and carry their legacy forward. And so as a succession plan, it lets these owners define their succession plan. And I like to say it lets them write how their exit, what it looks like, and it lets them rewrite their exit. The first ESOP I did, which Greg was a part of and his team, the owner actually closed the deal sailing across the Atlantic Ocean on the way to New Zealand on a satellite phone. The guy's never been back in the country. He's never been back in the boardroom. And why he calls and is a strategic advisor to the company, he had complete faith in his management team to make that deal close. And for him to get the seller note paid off over time. I have other owners that I'm confident will pass away in their seat at their corporate office. And the beautiful thing about an ESOP is both of those options are 100% fine. As long as you've put in place a management team that you trust to continue to run the business in the way that you're comfortable with.
I was gonna say too that one thing I like is it preserves the legacy of the company. So like a lot of times you'll see a seller that they don't want to give it up. They don't want to give the business up, or they're not comfortable. But when it's an ESOP, to Troy's point, it gives them some sense of control over what their exit's going to look like. And then a lot of times they'll say, well, okay, it's still, yeah, it's employee owned, but I'm still president of the company and I'm on the board. So it kind of feels like it's still my company. But then once the transaction closes, usually like after a year or so, in my experience, the seller realizes, okay, like this works, and it's still the same company. I really don't need to be here. Like I should be retired. I can start enjoying life a little more, and then it makes it easier for them to kind of turn the keys over to that next generation.
What about, we already talked a little bit about taxes. I know, Troy, you mentioned, the tax benefits on the way in, C Corps tax free on the way out. Can you guys elaborate a little bit, and whoever wants to share, feel free, but can you elaborate a little bit more on the tax advantages, for companies, whether you're an S Corp, LLC, a C Corp, the differences between them and kind of the basics, I guess, of how that all works?
Yeah, I can take first pass on
Sure.
that. And I hate to steal the mic, Greg or
No, go
Joe.
ahead. No, Troy, I
This
like
would
it because you've probably got the most kind of practical. I can give a lot of the good theoretical
Yeah,
background behind it, but I think with your numbers
yeah,
experience,
absolutely. Yeah, so when you think about it, really what a it when as I talked about on the front end, at the end of the day, you're really doing a couple things in an ESOP. You're setting up a qualified retirement plan, you're selling your business, and 9 times out of 10, you're working with someone like Joseph to set up bank financing. And so that bank financing, whether it's 25 to 35% of the business, you're taking some form of the money out. Um, and you're paying that money off, and you're paying the remainder of the seller note off over time. And really, when you go to pay that off, the difference between an ESOP and a management buyout, which is, some has some similarities outside of the tax benefits. Really, when you go to pay that debt off, the company's money is completely tax free if it's 100% S corp. And so when you think about it, if the company wasn't an ESOP and they went through a management buyout, and let's say they make $1 million in profit, they're going to turn around and send out something like 37% federal and 5% state. So about 42% of their money is going to turn around and flow through to the individual that owns it. And so they've only got about 58% of their money to actually pay down debt in the management buyout. In an ESOP, 100% of the company profit stays within the company. 100% of it flows through to pay off the owner. The owner still pays the capital gains, but they would have paid the capital gains either way. And so really you've got, that 42% of money back in the company that you're using to pay down debt. So you get through that pay down super quickly. And then you start to accumulate value within the retirement plan for the employees. And that's really the game changer within ESOPs, is the back tax benefits that Congress put into place, way back when. And we get the question a lot on why. Why is Congress doing this? And it's because at the end of the day, most people don't have enough money to retire. And so what does an ESOP do? Well, it puts the owner in a position where they're subsidizing their employees' retirement rather than the government subsidizing the employees' retirement through Social Security and other benefits. So the government's like, yeah, I'll defer those taxes. I'll let the owner sell tax free, because this is such a cool thing to redistribute wealth down to people that might not be able to make it in retirement absent an ESOP.
Yeah, and just to add to that, there's a code section 1042 that if you're a C corp, if you sell to an ESOP and you're a C corp, you can defer recognition of capital gain if you reinvest the proceeds into most stocks and bonds of American corporations. That's not currently available for S corps, but a couple of years ago in the Secure 2.0 Act, Congress actually did, and President Biden signed it, where they said if you're an S corp, you have to wait until I think 2028 to do this. But if you sell to an S corp, if you sell an S corp to an ESOP, you can take 10% of the proceeds and reinvest those and defer capital gain with respect to that 10%. You may say, well, big deal, 10%, but the reason people are excited about it is that's now in writing. That's now in a statute. And once you start, you have to start somewhere, and that readjust the budget baseline. So don't be surprised if in a few years they up that to 20 or 25%, and eventually they'll probably give that capital gain deferral, make it 100% regardless of whether you're a C corp or an S corp. So you get that benefit, and then as Troy said, you have a company that's basically a tax exempt entity. That's just huge.
Yeah, that 10% is like the gateway drug to full tax deferral.
Right. And Troy's right. Like both, like this is one of the most strongest bipartisan supports, like out of anything in Congress. I mean, not to stereotype, but Republicans like tax cuts. So hey, it's a tax break, great. Democrats like getting wealth and assets into the hands of workers. And most workers, if they were going to rely just on their wage income and their 401ks, they wouldn't really acquire enough wealth on their own. But with this ESOP, and to Troy's point, you kind of have the employer contributing shares of stock in the business they work for. It's a great way to get assets to these workers. So both parties love it, and they want to encourage employee ownership.
Let's talk about the financial side for a second, because the question that I get the most from people, and probably, in my opinion, probably the biggest unknown or misconception about ESOPs is the understanding how it works. Where when you sell a company to, whether it be a competitive buyer, someone in your industry, a private equity firm, through an auction. It doesn't make, it doesn't make a difference what kind of sale it is. You've got, maybe cash involved, you've got some lending involved, but at the end of the day, the owner's selling, or owners are selling the company at X, whatever X happens to be, and it's coming from an outside source or multiple outside sources. With an ESOP, it's confusing, I think, for most people, because the company's being sold to the company, being the employees. So how does it the owner get paid? And how is it different, or how does it contrast with a management sale, or just an auction sale?
Maybe let me start because I struggled with this for a long time and maybe being a non-financial person, but I'll let Joe and Troy correct me if this is functionally like part of the confusion, I think, is if somebody sees a transaction term sheet, there's a lot of moving pieces. So structurally, it's not going to look exactly like this, but functionally, what's really happening is the company borrows money. It's going to borrow part of that from a bank. Maybe Joe's bank lends a portion of the proceeds, and then the rest of it, the company's going to issue a note to the seller. So the company's borrowing money from the bank and from the seller, and the company then buys the stock. It's going to take the cash it got from its borrowings from the bank to pay the seller. Whatever it couldn't get from the bank, it issues a note to the seller. So the company's going to owe a note to the seller. So seller gets a note, seller gets cash. Seller then contributes the stock to the company. And then the company contributes the stock to the trust. Now, again, structurally, it may not follow that sequence. But again, functionally, what really happened was the company borrowed money to buy the stock from the seller and then contribute the stock to the ESOP trust for the benefit of the employees.
And maybe zooming out a little bit, I mean, when I think through it, it's like, okay, you can borrow debt from a bank, and most people do. But I think the easiest way to think about it to me is, okay, let's assume you borrowed no money, which happens. I'm working on a deal right now. They sell
Right.
a financial.
Yeah.
It's a company that makes $1 million in cash flow a year, and it's selling at a 5 multiple. It sells for $5 million. If they weren't getting interest on it the next year, what would happen is they would take a $5 million note on the front end, and they would get $1 million each year over the next
Right.
5 years, and the company would buy itself out over the next 5 years. Fundamentally, as simple as it can get, it's that.
Yeah.
When you throw in some other concepts, really what happens is the bank lends a chunk of that 5 million, the seller takes on a note of that 5 million. The seller's going to get a really good rate of return on their note, right? They're going to get like a 12% interest rate because they're taking on a pretty heavy, they're subordinated to the bank. The bank's going to require some sort of return on their loan, a SOFR plus, some number spread to make sure they're made whole. And the company pays itself out with the cash flows. The beautiful thing is, tying back into the earlier conversation, all that cash flow goes to pay down debt, right? Because you no longer have to pay that tax. And that's what really opens it up to pay down that debt so quickly.
Joe, would you add anything to that? I'm on the financing front.
Yeah, so I would say you got ESOP companies. Yeah, I would kind of, everybody explained it well, but it's 100% debt. Now, who the creditor is, I think they explained it. And Troy's one example, which is an extreme example, only because it's 100% seller debt. It's $5 million, but it's debt. When you take a step back, you were talking about other companies. I normally try to like blow things up and think of like the biggest deal. You see like AT&T buying a company, and you see that come across CNN, and they're buying another public company. 99% of the time, there's an exchange of stock, and then there could be potentially cash. So there's not debt on that deal. It's uncommon. When you see AT&T, again, a public company, buying a private company, sometimes they will exchange stock, and then a lot of times they will do a leverage buyout, or there's debt. You mentioned the management buyout. That typically is exchanged. There's debt. So an ESOP is 100% debt. And that's what makes it a little bit different. And then I think people do kind of overanalyze who's doing what. And then when you have a PE deal, because they're flooding the market so much, you normally will roll over your equity. I think that was mentioned earlier. So again, in an ESOP, you don't really, it's outside my bailiwick, but you can sell the company, and then you can become, if you continue to work there as a shareholder, it's sold. You can get into the program, but in a PE deal, you sell, and you may sell 80% of your company. If it's worth $10 million, you actually hold on to the stock. So that's not 100% sale, and you don't know exactly how the PE firm, they could write a check. They can do it a variety of ways. All ESOPs are debt. It's 100% debt, because the beneficiaries, which are the employees, they're not putting in any money, right? So, and then that, unfortunately, when people start talking about debt, I think they kind of get confused, and overanalyze it a little bit.
Yeah, no, man, that makes sense. And what about vesting? How does vesting work with an ESOP? What happens to shares when an employee leaves the company or retires? And then, again, kind of along the lines of questions I hear and misconceptions, perhaps, what are the complications that arise with liquidity, if there are any complications in situations like this? And is this when a bank steps in to help, or is that not an issue?
So maybe let's start. There's kind of two parts of that. So we'll start with the vesting and how shares get allocated to participant accounts, and then Joe and Troy can then talk about, once the shares are there and they retire, how they get paid. So first thing is, you can, as an employer, when you're setting up the ESOP, you can make employees have to work a bit to get their stock if you want. There's usually kind of a couple ways we do that. So the first piece is, what do they need to do to get an allocation of stock to their ESOP accounts each year? Most common method is, we say you have to work at least 1,000 hours in any given year and be employed on the last day of the year. So if you work fewer than 1,000 hours, you don't get stock, or even if you do work 1,000 hours, you're not employed on December 31st, you don't get any stock allocations. What that does is, it basically kind of leaves out part-time employees or seasonal or transitional employees. Depending on the business, like with some construction and contractors, maybe they have an important group of people that work kind of March or April to October, November. So for those, we might say you got to be employed October 31st if we don't want to leave them out. But the point is, you can put some boundaries to say, how do you get stock in the first place? And then the second piece of that is the vesting schedule, which says, okay, I got stock allocated to my account this year, but if I quit, I may still have to forfeit that stock back to the plan. There's two common ways to do that. It's governed by the tax code, but one way is to say you're 0% vested for the first 2 years. And then if you've been employed for 3 years after you started participating in the ESOP, then you're 100% vested. So under that schedule, so I get a contribution. Let's say we create the ESOP in, this year, say effective 1/1/24. So I'm employed after this year, I'm employed in 25, but then I quit, say in February of 26, I'd be 0% vested in those allocations, and that stock would be reallocated among employees. The other way you'll see it sometimes is, you'll say 0% vested after 1 year, and then 20% a year after that, so that you're fully vested after 6 years of participation. The point is, again, like it takes some time to get to 100% vesting. So if you terminate before the vesting schedule, you may be forfeiting some or all of that stock. So let's say you are vested, or to the extent you're vested, then you retire, you terminate. There's a couple things you can do there. So one, if it's a termination that's not death, disability, or retirement. So let's say it's somebody in their mid-40s who just quits and wants to go somewhere else. You can actually make them wait 5 years before they start getting distributions, and then you can pay them over in 5 annual installments. So basically pay them out in years 6 through 10. There's a cash flow management piece to that. It's also a deterrent to say, oh gosh, if I terminate, I got to wait 6 years before, or more. If they're retirement eligible, and we can define retirement as, like, say, age 60 or 65, or maybe even 60 with 5 years of service, then they have to get distributed by the end of the year after the year in which they terminate. But at that point, they've probably put in a lot of time anyway. You don't mind doing that. So point there is you can put boundaries on how do you get stock in the first place. Then once you do get stock, there's a vesting schedule that says if you quit shortly thereafter, you may have to forfeit the stock. And then again, you can do some cash flow planning with the distributions. But the second part then goes to, okay, well, people are vested and they retire, they have private company stock. How do they get paid? Company has to then buy them out. How do they come up with the cash to do that? I've seen some examples, but Troy, that probably comes up when you do some of the planning. Maybe you can give some thoughts on that.
When you think about it, as Greg said, you're going to earn shares through vesting on the front end, and that's maybe one big misconception about an ESOP that, maybe before I entered the ESOP community, I didn't really understand. You don't own 100% of the company year one, and you're getting allocated the company's profits. And Greg mentioned this, but just to drive that point home, you earn shares of the company over time. And so I think a lot of people think of an ESOP and think, company makes $1 million in profit. I own 10%. I get $100,000 that year. And that couldn't be further from what actually happens. What actually happens is company makes $1 million in profit. They're selling at a 5 multiple. It's worth $5 million. You own 10% of that. So you have $500,000 sitting in a retirement plan, right? As Greg said, how that retirement balance gets paid out really depends on if you're vested or not. If you are vested, let's say you retire, you're going to get 100,000 in year one, 100,000 in year two, 100,000 in year three. To make things simple, it really works a little different than that. But to make things simple, that's how it works. Really what the company is able to do is they work with what we call a third-party administrator. There's some big companies out there that help plan for this, right? So they're getting your census each year. And they're getting your actual employees and what their share count looks like. And they're modeling what we call repurchase obligation and what that liability is going to look like in the future. And they're sensitizing that. And you're planning for that liability that's going to come, over the next 5 years. You've got a chunk that's right in front of you. The people already retired, right? That's coming. You've got another chunk of, maybe someone, becomes disabled during the year and that pops up. So they're planning what that liability looks like. And it's not something that's just going to sneak up on you. The reason the code's written the way it is, where, you get paid out over 5 years, is so you don't get a run on the bank like Silicon Valley Bank. How you actually fund that repurchase obligation varies. Some people, take on debt for it, because when you think about it, by the time that liability actually comes due, you're probably through the majority of the seller note payoff. So maybe you have some debt capacity. Some people set up sinking funds with annuities. Some people set up life insurance. So you'll see that occasionally. And some people just stock away cash. It really depends on the company. And there's not a one size solution, but there's a lot of people to help you get there, and what the best kind of way to fund that repurchase obligation is. The best way I think about it is just plan for it. You're going to be looking at it going forward, no different than if you're going to go out and buy a house in 2 years. You're going to put a plan together. And Adam's plan might look different than Troy's plan, but as long as we're both putting a plan together and it's a reasonable plan, we can go out and achieve it.
I can agree with that more. In fact, this is probably a good time to plug exit planning, business transition planning, whatever you want to call it in general, which is doesn't matter if you're selling via ESOP, if you're selling private equity, if you're selling to an industry competitor, it doesn't make any difference. You should not just wait to sell until you're ready to sell to start planning. I think you should be planning well in advance of when you're ready to sell, but I'll just shut up and we'll move on here. Let's talk about valuation. How is the valuation of a company determined for the purpose of an ESOP sale And how is it different from the valuation in any other type of sale, or is it different?
The ESOP code is written that an ESOP can sell for no more than fair market value. And so what that means is that when you go out to sell, you can sell for up to what fair market value looks like. What is fair market value? It's, in the eye of the beholder, but in an ESOP deal, it's going to be determined by an external valuation, and they're going to go through and run through some sort of formal valuation. The majority of people do what is called a discounted cash flow. You're going to get 5 years of projections and come up with, based on that, what is the company worth? At the end of the day, I think the simplest way to think about it is, you can sell it for the same amount that you would sell it to, on the third party market, absent two things, absent synergies. So you think about someone coming in and buying another company. If you've got, a landscaping company and someone that's out selling mulch, like there's a synergy there, right? And there's probably a profit that drops through as a result of putting those two businesses together. When you sell as an ESOP, there's not going to be a synergy, so you can't take that into account. And the other side of that is if there's a strategic portion of it, right? Where you're going in and you're a general contractor, but you're missing that one customer that's going to take your business to the moon. All of a sudden, you can go out and you're willing to pay a little bit more because you see an upside of purchasing. Absent those two things, you can really sell for what you would sell for on the open market as long as it's supported by a fair valuation.
I would add too that from the Department of Labor, because that rule about appraised fair market value comes from the Department of Labor, but it's more of a process. So what they're saying, so what the Department of Labor cares about is, okay, how did you come up with this number? And if there's documentation, and again, the ESOP community, like the financial professionals are good about this. I mean, you have Troy do a feasibility study, he'll show you the different valuation methods, and then the trustee will have its own appraiser that goes through that, and they'll have this huge valuation report. But basically, just they want to see in writing that there was some sort of objective analysis performed and that the trustee was engaged, that the trustee didn't just completely dump the work off to a third party. The trustee actually read that report, asked questions, and again, there's documentation to that.
I'm curious though, I know because we've talked about different types of companies, different types of sellers versus buyers. And obviously with an ESOP, you're selling to the company. We've talked about valuation, but in what circumstances where does an ESOP make sense versus not? Or in other words, what are some model companies that if, the three of you are looking at, 10 companies, in what circumstances where, companies 1 through 7 are great candidates because of X, Y, and Z versus companies, 8, 9, and 10 are terrible examples or terrible candidates for, the other reasons, So when does it make sense? When does it not?
I'm guessing all three of us may have a slightly different answer because there are financial considerations, but from my standpoint, increasingly I'm of the belief of what's the culture of the company. Because I think if you're not ready financially, you could get there. Like Troy and Joe could help you get there. But to me, it's if I hear of a business owner who says, this company's like a child of mine, I don't want to see anything happen to it. I've got some key employees who've been here a long time. I want to do right by them. That is usually a very good sign that an ESOP can work. In contrast, if it's the owner or the seller was kind of an empire builder and kind of everything ran through that one person, all the customer and vendor and banking relationships were all through that one person, and they haven't really shared anything or developed talent, that's a red flag. It doesn't mean you couldn't get there, but it means you got to develop a management team. But like I said, that's kind of more of like the softer side, the cultural side. I think Troy and Joe would say there are some financial considerations there too.
Yeah, Joe, what would you say on the financial front?
Stable cash flow. So year over year, normally a 5 year to 7 year period, 3 years at a minimum. So it's okay if the revenue is up or down a little bit, but you're looking for what we call the EBITDA, and it's great if the EBITDA is increasing. I would say if it's like going up by 20 or 30%, that doesn't necessarily mean it's not a good candidate for an ESOP, but you just need to understand why. So that stable cash flow is good. And so for probably people that are vendors that are working with ESOP companies, or potentially there's people that are listening to this podcast that have sold, they own several companies and they've sold and done an ESOP. I think they're going to understand that when a company's in growth mode, you have a finite amount of cash flow, right? So when you're growing at 20 to 30% on your EBITDA, that's going to chew up cash, right? So, your receivables are growing, you got to make inventory purchases, and ESOP is great. The benefits are amazing. But for practical purposes, I think, at least in the finance world, we consider the ESOP, it's not like bad debt, but it doesn't add any value. Whereas when you buy like a piece of equipment, conceptually, the new equipment is going to make things better, faster, smarter. So your dollars can only go so far if you're growing rapidly. That's the biggest thing. Greg and I touched on this in the previous call that normally companies that have consistent, stable cash flow, I'm sure there's some outliers, but most companies, like, then you can like peel back the onion. Guess what? They have good management. Guess what? They have a good culture. They have people that care. And so some of the stuff that Greg's talking about culturally that he looks for, we look for as well. But a lot of it starts with stable cash flow. And then we don't, the bank doesn't write the rule. Like, I don't work directly with the IRS. I'm not certifying anything. But companies that are below $1 million in EBITDA, or they have a low count of employees, I'm not saying I wouldn't do an ESOP. We need to look at it, but that's kind of like a watermark where I kind of look a little closer, right? So if somebody has like $5 million in EBITDA in general, and it's stable, I'm like, that's a good candidate. I want to learn more. But that's what we would look at.
You actually took the words out of my mouth. I was going to ask about employee count. So, I mean, is there a kind of a rule of thumb, I guess, below which, number of employees, assuming revenue's there, EBITDA is there,
I'll
where
let
it's
the
too
other
few?
two. I mean, I would say there's more than a rule. I mean, there's a certain. I'll let the other two jump in. There's a regulate. I mean, there's a certain amount that you need, and then there's, for our purposes, we've got to be very careful. I would never tell somebody, hey, you can't become an ESOP because I said so, as a bank. But I may view it as a riskier transaction. But I think Troy and Greg, or but one of them or both, could probably answer from there is some more specifics.
Yeah, we typically, so within ERISA, there's no different than you can only contribute a certain amount into a 401k plan. Within ERISA, there's only a certain amount of benefit that can go, to employees to pay off that loan. We've talked about the debt. And just as a rough barometer, we typically say around 20 employees is roughly where we would target. Less than that, it gets complicated. It's not impossible, but we typically say less than 20. And we typically say, when we're looking at transactions, if you're less than, I don't know, $3 million in EBITDA, it gets a little difficult. And the reason that we say that is because there's a cost associated with everything we're talking about, right? You've heard the words third-party administrator, you've heard the term trustee, you've heard the term valuation, there's additional insurance, there's just an additional rigor associated with an ESOP and an additional cost. And what we found is once you get, and maybe it's 3 million, maybe it's 2 million, but the smaller the company, the harder those barriers are to get through. And I think, somewhere in between those, it becomes much easier.
That makes a lot of sense. And something you said earlier, Greg, that I just want to chime in on. You mentioned that with an ESOP, candidate, that if you've got an owner who everything flows through them, the business comes through them, the relationships are with them, there's not much management structure in place. And the recommendation, obviously, there would be perhaps this doesn't make sense, and that they first and foremost need to build that management and structure and set up some delegation. I would even argue that that's the case with all sales, and that because I know when I'm talking to people, owners, that one of the many red flags I look out for is how many of the relationships that generate revenue are directly related to the owner because from a buying perspective or a buyer's perspective, I'm going to be concerned about, where are those buyers going, where are those customers going if the owner's gone, if there isn't some sort of, I don't know, ancillary relationship with the rest of the team, if that makes sense. Would you agree with that?
Yeah, absolutely. I mean, any buyer, they're going to be concerned to say, okay, when you retire, seller, do all the relationships go out the door with you? I mean, in some ways, it's no different. Even like with law firms and accounting firms, like we kind of force some of our older partners, hey, like before you retire, you got to start introducing your clients to some of the younger partners because we want to make sure these clients are firm clients, not just your personal clients. The same thing with any business. You got to make sure that the customers and the relationships are really company relationships, not just the business owners.
No, for sure. And
Yeah, and I'll add, Adam, I think one thing that, just on what we look for ESOPs, I always start with an ESOP of, why wouldn't you want to do an ESOP? And the biggest thing that I start with there is how confident are you in the future cash flows? And I think that ties into what Greg's talking about. If all of your relationships are with one person in the company and you're not really sure how they're going to tie into the ESOP, it might not make sense. With a third party, you sell it and you kind of wash your hands of it and move on. With an ESOP, you're going to get paid out that debt over some period of time, maybe 5 to 7 years. And if you're not confident in your company's, cash flows over that 5 to 7 year period, an ESOP probably doesn't make a ton of sense.
right. Another red flag, perhaps, right?
Yeah, yeah.
What about governance, management decisions? How does an ESOP impact those things? How do employees typically participate? What are their rights, responsibilities? How does management change?
Yeah, I wonder, Troy, if you kind of run into this question too sometimes, because I'll often get the question, wait a minute, it's employee owned, so the inmates are running the asylum, and I don't know, wait, do I have to share my financial statements with my employees? And so the answer is no, actually, you don't. The employees themselves are not shareholders. Under corporate law, the ESOP trust, and so the trustee acting on behalf of the trust is the sole shareholder, assuming the ESOP owns 100%. The employees are beneficiaries of the trust. So they have no rights of shareholders under corporate law. So you can relax about that if that's a concern. It might make sense to share some financial information with them because, again, if you're trying to promote this idea of employee ownership, they probably should have some clue what's going on. But legally, what happens is, okay, so you got the ESOP trust as the shareholder, but you still have a board of directors of the company, just like any other corporation that sets the broad policy. Board hires the officers of the corporation, CEO, CFO, and whatnot, and the officers run the day-to-day operations of the company, just like any other corporation. What the trustee is going to require is usually you'll have to have at least one outside independent director. So one, you'll actually have to have a board. Like a lot of times we'll see these companies that maybe don't have a board, or the board's just the business owner, or the business owner's spouse, or maybe some other key employee.
Right.
So the trustee is going to say, okay, look, I'm the trustee of like 30 or 40 or maybe even closer to 100 other ESOPs. So like I have no desire, I don't have the time or the ability or desire to manage this company, but I just want to know that there's an appropriate structure, management structure in place. So they'll say, set up a board, and hey, seller who has this note, you can absolutely be on the board. And if there's someone else at the company or some confidant you have that you want to be on the board too, great, have at it. But I want at least one person that isn't kind of subordinate to you in some way, or a service provider, or feels in debt to you, to kind of be my eyes and ears on the board. And so you have this 3-person board set up, and then they're just going to want to see consistent meetings. So like usually one meeting you talk about budget, financial matters. Another meeting you talk about HR, executive compensation matters. Another meeting you may talk about strategy. And they just want to make sure that those meetings are in place, that they're informed. I kind of think of it as the trustee is similar to if you're a shareholder of a public company, you're not making decisions, but you're getting quarterly and annual reports. And that's kind of how the trustee is. They don't really want to make decisions, but they want to be informed, and they want to make sure that they have the information they need to make a valuation. So from that standpoint, it's a pretty good check and balance. You do have the trustee kind of overseeing the board, but the board has the authority to hire and fire the trustee too. So they both kind of police each other, and it's really effective. And so that one thing I say, I mean, you got to be a little careful how you say it, is you may not own the company anymore when you sell to an ESOP, but you still have a pretty good amount of control. I mean, you're still, as a seller, you'll probably still be the president of the company. You'll have a seat on the board. So it's not quite the same as if you sold to a third party.
That makes sense. What about challenges as we wrap up here? I mean, what are some of the common challenges that companies face, whether it be when implementing or maintaining an ESOP on an ongoing basis? Maybe things to avoid.
I'd say, oh, go ahead, Troy. I was basically going to turn it over to you and say you need to plan ahead and have a feasibility study, number one. So it's a good segue to you.
Yeah, I think there's a couple places. I think a lot of companies that do ESOPs, probably were pretty risk averse historically, and didn't have, a debt load. And so when I think about it, it's, thinking ahead of how are we going to make decisions on when do we pay principal down on debt, right? Which looks a lot different. And so, Joseph and his team, or whatever bank you end up going with, are going to come in and they're going to say, hey, we're going to require these types of reports. And I think making sure your financial team is set up and ready to go with that. I think thinking through how you're going to engage your employees within the ESOP, right? There's some level of uneasiness. All decisions used to flow through Sally, the owner. And now all the decisions flow through a board. But the further away Sally gets, right? At some point, Sally's probably not even going to be on the board. How's that company? Who's the leader? Who's the CEO? How do we start to operate like more and more like a company that's an ESOP, and less like a company that still has a single owner that flows through the board? And then just getting ready for some of the reporting requirements. You've got a great team of people around you. You're going to have your trustee. You're going to have your valuation team that's going to be working for the trustee. You're going to have the TPA. You're going to still have your people like Porter Wright and Greg that are around to help with, ERISA related matters. But there is some additional things that pop up of being an ESOP that you've just got to start preparing for.
And I would add that post closing education is important. What I see is, like, sometimes the sellers think that because they were entrepreneurial, that, oh, being an employee owner, that's such an amazing concept, it speaks for itself. And the employees are just going to get it and appreciate it. Maybe a few will, but it's going to take a constant stream of communication. Like, a lot of the good companies will maybe every quarter, every 6 months, have a lunch and learn, or even just a newsletter that explains something about the ESOP. As time goes by, they may have some retiree who says, like, how great the ESOP was. When they get their when the benefit statements that show what the account balances are worth, they'll have somebody explain to them, hey, how was the stock price calculated? What does this mean for you? And then if you have that education combined then with getting benefit statements after a couple of years and the employees see their account balances grow, that's when the light bulbs start to go off for the employees. But just to assume that the concept itself and just looking at benefit statements is enough, it's often not enough. You gotta constantly kind of sell or explain the benefit of the ESOP to the employees.
It's interesting. That actually surprises me. I would think that the employees would get it pretty quickly as soon as they see that number on a piece of paper. But yeah, that's interesting.
That number happens slowly. So when you think about how
Yeah.
companies, they're taking on 100% debt, right? So that $5 million company we're talking about has $5 million in debt. Well, the employees' statements are going to say, hey, you own like $1. So that statement happens over time,
Yeah.
the balances. But driving that behavior is super important, as Greg said. And I think it's more about feeling the sense of ownership and less about the dollars at hand. And so you see a lot of statistics out there that, ESOPs drive productivity increases of 3 to 5% the year they're established. 100% true, but it's not necessarily just implementing the ESOP. It's educating people on being employee owners, like Greg talked about, that really drives that point home.
Not just a transaction. Yeah. Well, speaking of behavior, I think that I'll just finish here by saying that it's if you're an owner and you're listening to this, you're watching this, and whether it's what it's July still, I guess, of 2024. So whether it's 2024 or 2026, and you find this thing when you're Googling, don't wait to start planning. Whether it's an ESOP or any other type of sale that makes sense for you, that's one of the many steps in the process of business transition planning, is determining what type of sale makes the most sense for you and your company. So be sure to start that planning process early. In a perfect world, at least 2 to 3 years before you sell. Don't wait until you're ready to sell. And then on top of that, like I mentioned earlier, I think it's crucial for people who have no desire to sell in 15 years to do that planning now, because your company is going to grow exponentially, both on an absolute basis as well as a relative basis as to your multiple. If you do this type of de-risking and planning now and run your company like a real big boy company, it doesn't really matter how ugly your baby is. At the end of the day, it's just business. So do your planning now and set yourself up for success. So if you'd like to get a hold of Joe, Troy, Greg, you can find them all on LinkedIn. You can also find any the other links, contact information, emails below in the show notes if you want to check that out and shoot a message to them directly. But as I always say, there's thousands and thousands of podcasts out there these days, and you chose to give ours a watch or a listen today. So thank you so much for tuning in, and we'll see you next time.
Thank you for joining us on the Elevate Your Business podcast. To complete our free business valuation quiz, to check out additional articles, webinars, videos, and other educational resources, or to set up an intro call with your host, Adam Koch, just head over to elevateandexit.com. This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for financial advice. None of our shows engage in rendering legal, financial, tax, or other professional services. Always talk to a professional business transition planning consultant or certified exit planning advisor before implementing any of the ideas shared in this episode.